All right, so we're looking at the S&P futures contract for June 2022. On the left-hand side, you can see that we have a daily chart. And on the right-hand side, it's a 1 hour chart. So I'm only going to do this to save time. Also bring your attention to levels that are sensitive on one time frame, higher time frame, and how it's subordinate on the lower time frame to those higher time frame levels. If you don't know what I'm referring to, obviously you'll understand more as we go through. All right, so this morning I had a short little video that I posted about how we had recently been in this trading range in here. And if we were to start to move higher and had displacement to the upside, this could have been a draw on liquidity. This is the objective I was looking for near term if we were to break higher. We had news this morning and unemployment data, which obviously, given the state of affairs at present, it's a heavy weight around the neck of the markets. So we had a move lower prior to the opening at 9:30. I talked about how until we had some kind of displacement, I wasn't really excited about doing much in the marketplace. I felt that 40.70 was a nice draw on liquidity, which would be below these relative equal lows. I posted that obviously before 9:30 a.m. So it gave you a target, okay, or my bias. So I'm thinking what? If I'm pointing down here before 9:30, am I suggesting that we're going to go up here or here or here? No. So I'm looking for evidence to support the idea that a run below these relative equal lows is warranted. I also stated if we went below those lows, that we would draw into that fair value gap. I came out in video, explained that I would be more interested in seeing this level down in here. And if we did, we would draw into this area here. Now, that is suggesting several things. Number one, we're expecting the volatility, or I'm expecting the volatility, to be significant enough to take us below these lows. And if that was to occur, then we're going to draw all the way down into here, which means what? We're going to have a small range day on the daily chart or a large range day. Clearly, a large range day. So there was a lot of things that I laid in your hands this morning that hopefully give you hope that these things are predictable. All right, so on the daily chart to the left, you can see we have those relative equal lows I mentioned. The draw on liquidity was there. So I was focusing what? Sell side, or I had a bearish bias. I gave conditions that if we went below there, it's not going to go down there to go up. It's going to go down into this area here. So with those levels transposed over to the hourly chart now, this level here is this level on the daily chart. This level down here is this level. Now, obviously, some of you are like, that's pretty obvious, but you'd be surprised how many new students I have, and they get lost in the time frames. So whatever you're doing in your higher time frame, you want to start your annotations there, but keep them simple. You want to see a level that it's going to draw to, and or what key levels that may be a factor for changing or suggesting a bias is in play. As I did this morning, I said, I believe we're going to go down below here. I think that's likely to occur. And if that does happen, we're drawing into this area here, not just going below relative equal lows to go higher. Because there's a lot of people all around the world that are being exposed to my content, whether it be directly from me or someone that's longed my concepts and have tried to create something new with a twist of their own. They're teaching that it's always a relative equal low or equal lows to hit those and then go the other way. That's not the case. Narrative must be understood. And narrative, unfortunately, requires experience. And experience is what I'm lending you. So over here on the hourly chart, we had a fair value gap here, swing low. We had displacement. We consolidated going into midnight last night, New York time. It rallied up, traded into a fair value gap here, and up into the bearish order block. So we have this order block. It touches it. You can take that trade, but I'm trying to draw your attention to these areas here. Okay, where there's 3 candles, 1 candle in the middle that has an exposed area that is not overlapped with the previous candle's low, immediate candle to the right of it. So there's that little section that we call a fair value gap. Price goes above it, hits the order block, but look at the candles. See how the candles' bodies stay predominantly in between these 2 levels here? So yeah, there's a wick and there's a wick, but largely the volume is encapsulated in between these 2 levels. I drew your attention here. I mentioned how we would likely go below those lows. And then we have an old low back here. So even if we weren't looking at my commentary or watching it, this framework here, then running to that low, is something that you should have identified. So you had a bearish bias given to you. You had an objective, a draw on liquidity, and in the chart here, I'm showing you the framework for the daily range. The opening price at midnight. I teach there typically if there's going to be a down day, which is what I was suggesting, before the market opens at 9:30, we would see a bearish day and look for a draw to 470. If that occurs, your attention should be down between these two levels here, based on that daily chart. Okay. Now, incorporate power 3. My power 3 concept is the accumulation of shorts, the manipulation of those individuals that were already short. That's what this is here. That's a Judas swing. The market goes up to a short-term premium, which is high to low, back into a premium relative to this dealing range high and that dealing range low. Then the market breaks lower, trades below the short-term relative equal lows here, retraces, consolidates a little bit, breaks once more, consolidates, and then attacks the sell side here and aggressively runs through the 470, which is what we were anticipating based on my commentary before the market opened. And then we take our attention down to here. So if you are short, you take a partial here, and then you wait for the daily range to fulfill. That means you have to submit yourself to time. What time? 3 o'clock to 4 o'clock. Wait to that last hour of trading, because you'll get the delivery of price when it trades down into that. All right, now we have the 15-minute time frame on the left-hand side and the 5-minute chart on the right. You can see how we rallied up into that fair value gap on the hourly. We broke down. Once more, traded back above the opening price at midnight here. Breaks lower, consolidates. All of this we'll talk about later in the video. Then breaks once more, trades up into a fair value gap here. Breaks lower and aggressively runs into that higher time frame daily fair value gap. On the 5-minute chart, you can see here we have the equities opening at 9:30 a.m. here. And I mentioned when we were down here, I said price is initially showing weakness. It's going lower. Traders are going to get caught short doing that, chasing price going lower. They're going to reprice to 41.05. There's buy side liquidity resting there and a fair value gap. The market immediately after my post runs to that level. I engaged that with a demo trade. I entered it and I took profits below that short-term low here. And then I'll teach you how I knew this was reversing on me and saved my stop, and also took a second partial off. It rallied up once more, blowing out that short-term high. So we have a lot of chop in the initial opening range. Low, higher high than that high, lower low than that low, lower low again, then rallied through this high and left this fair value gap. Consolidate a little bit in here, traded back down in, once more back into the opening price at midnight, which is this line here. If you're bearish, you want to be going short at or above that level, or as close as you can get to it, like this one here. Okay, the market drops down between 11 o'clock and noon. It consolidates, then retraces back up, takes buy side here, breaks lower, returns back to a swing low, which we'll talk about in a moment. Breaks lower again, aggressively runs for that 470 level, and it's off to the races down into the daily fair value gap. Now, if you look at the daily range through the scope of a 5-minute chart here, you can see the opening price here at midnight. Prices gravitates around that. And in London, they rally and start building in a premium ahead of the 8:30 time window. The market creates the high, breaks, takes out short-term sell-side liquidity here, retraces back up into, consolidates for the majority of the afternoon. Then it breaks lower and then aggressively attacks the sell side below 470 and then going right back down to that 440 level and then hanging out and consolidating and closing inside that larger daily fair value gap. Now, I want you to take a look at this price action here. We're looking at the afternoon. So with the morning aside, because I walked everyone through that basically on Twitter and with pre-market analysis and commentary, the rules for a afternoon session trade. Before you even consider trading in the afternoon session, you have to consider, what is the daily range trying to do? Is it trying to expand higher? Is it trying to expand lower? Did it reverse in the morning session? And is it going to have a counter trend move Or is it going to just consolidate because it's waiting on a big news event the following day? Today, we had a big news event. We had employment data. The market consolidated. And we had a bearish bias. We were looking for 4070 based on my experience. I was generous enough to give that to you beforehand with commentary suggesting that we would trade down to that lower time frame fair value gap on the E-mini S&P's daily chart. So the framework was one-sided. It was not ambiguous. It was specific about what we were looking for. Once the market started to break after lunch, when does lunch end? At 1 o'clock in the afternoon, New York local time. That is here. So 12 to 1. There is our New York lunch. If we're bearish, what did I teach you? The market will do what? It will clear the stops during the lunch hour. What highs were formed in the lunch hour? Here, and prior to it going in, this was the buy-side liquidity pool or short-term high. So at 1 o'clock, the algorithm reprices and runs to take the stops above the buy side here. So during the lunch hour, we're seeing that it took the stops here. You can, if you're aggressive, you can put on a trade here because we're in a directional move. We're trying to anticipate a large range day, and large range days can typically form with a busy lunch schedule. And I just recently taught this, that the market, if it's going to be a fast market, during the lunch hour, it can create a significant high or significant low. But the premise mainly is, if you're bearish, you're going to be looking for the highs to be swept because they don't want participants to be profitable that may have assumed a short position from the morning session, or prior to this high forming, they may have already been short here. And instead of letting the market release and break to a lower PV raise in a discount market, the algorithm reprices, knocks those individuals out because it floods the market with what? Buyers at a higher price. Higher than what? Than it was here. Than it was here. So smart money utilizes this run above this short-term high as an influx of buying interest and liquidity that's available immediately while the market's being priced here and held at that level. Smart money will go in and sell to those buyers that their orders will be resting above here. So their stops are being tripped. Their short position is being knocked out. And conversely, there's traders that would see that high being broken as a means of getting long. And you have a buy stop that would trigger them getting in on a breakout. So smart money is cannibalizing those two types of orders. What orders are they? Buy side liquidity. So the counterparty to their short has to have buying interest. That buying interest is being engineered by the algorithm when it runs up here. So smart money goes short here with the expectation that they can take off a portion here back to an old low of 470 and then 440 and then into that fair value gap on the daily chart. Now, what's the first element to algorithmic theory? Price or time? Time. So time begins in the morning session for us as a index futures trader at 8:30. That's when the news embargo lifts. That means at 8:30, that's when there's usually a news event or some kind of economic report that comes out at 8:30 New York local time. So that's the reason why I tell you to set your clocks on your TradingView platform here to the local time in New York. This candle right here is the 8:30 candle in New York time. This morning, I outlined how I felt that we would likely see the market move to a liquidity pool, a specific liquidity pool, and it would draw down and attack the sell side. I teach my son to look for setups that are going to target a specific pool of liquidity. It means I have to have a clear idea where the market's likely to go up for buy side or down for sell side. I'm not trading a support and resistance idea. I'm not looking to go to a level to watch it repel away. That's not what I'm doing. That's a fallacy. That's the reason why retail traders drop the ball so many times or blow their accounts and never find consistency, because they're trying to force something that is designed to fail. I don't know why it's so hard for people to acknowledge when they are met with extreme adversities trying to force retail logic to work. Can you make money with retail concepts? Yes. Yes, you can, if you understand how to reprice like I'm teaching it. If you did those types of things without understanding why the market should do what it's doing, why is price booking the way it is? What does that mean? Why is price going to these specific levels at the time it's doing it? There's a logic behind that. And for some that want to say, there is no technical science. At some point, when does it stop becoming useful? All of it's useful. Every tiny, minute little fluctuation in these price movements are absolutely controlled, engineered, and premeditated. Either by AI, artificial intelligence, that's the algorithm. It's following the code that's been written for it. The first element is time. So at 8:30 in the morning, that's when a news embargo lifts. That's the first element of time that I taught you with this model. The second one is 9:30. Okay, that's right here. The first here. At midnight New York local time, that opening price is here. Did the market rally above that opening price at 8:30? Yes. Are we bearish? I proved this morning I was expecting lower prices. I preferred lower prices. So that means we're above the opening price at midnight. So my Power 3 concept is you want to be shorting at or above the opening price at midnight in New York local time. If you're trying to capture movement on a daily range on a down day. So that opening price, look what happens. We run up, take out short-term highs here. That's a short-term run on liquidity. Who's going to have stops at that 1 minute? Anybody that would have put a stop loss in on these lower time frames. There's traders that are doing that all the time. The algorithm is not aware of how much volume rests above or below a high or low that's penetrated. It has no understanding of that. It doesn't need it. For folks that are perplexed by that statement, and I've said it several times in the past, you ever play a video game? How about Pac-Man? I'm a child of the 70s. I was born in 1972, August 8th, 7:11 p.m. See that? 7-Eleven. Lucky 7-Eleven. I came in the world with some luck, didn't I? So when you look at a game like Pac-Man, okay, what keeps Pac-Man inside the boundaries of those lines that make up the maze that it runs around and collects and eats those dots until it gets to a power dot or chased down and killed by the ghosts? The program language keeps him limited. The playboard or game maze has limitations. Those limitations are programmed as such. Every video game today, they have a map. Okay, Fortnite, Call of Duty, Battlefield, all that genre of video game creation. All of those maps or territories that the player gets to enjoy and explore, they have limitations. Okay, the daily range has those limitations programmed into it as well, until manual intervention is brought in and those initial boundaries are removed. Okay, so think of price like that. So if you know that we're likely to see that in terms of like an analogy, we're at 8:30, we're above the opening price at midnight. We ran a short-term high here. The algorithm doesn't care how many orders were above that. It doesn't care. It just has to take out a short-term high. It does. So it's at a premium. It took out buy side. So what is it likely to do now? Because we're in a bearish day and we're above the opening price and it's at 8:30. Reprice for what? Sell side. Where's sell side? This level down here. 4101. Or what? 4100 big figure. 4100 level. So there's liquidity resting below that. What kind of liquidity? If market's price is here and sell side is here, it's old lows, there's sell side below that. So market price is here, relative equal lows in the past is this level here. Go back in the beginning of the video. Okay, you'll understand what that level is then. That liquidity is sell side. We're at a premium here. This will be a discount because market price is here or here. Anything below it is what? Discount. So the algorithm goes from buy side liquidity at 8:30 on a bearish day above the opening price. Wait for the market to trade lower. It does. Short-term low. See that? Swing low. Trades through it. Creates a fair value gap. Rally back up to it. Sell short with the expectation it's going to run to sell side liquidity. This is what I'm teaching my son to do at 8:30. That's all he's trying to capture there. In this move, he may not run all the way to the sell side. He's going to get his 5 points. Once he does, he's stopping. he gets out. And then he watches the move go to the sell side liquidity pool. What I teach my son to do is at 8:30, he looks for a setup like this. If it's a bearish scenario, he's looking for liquidity below the marketplace. And he's looking for some type of framework where it gives a fair value gap. That is his pattern. That's what he's settled in on. And we're going to run to liquidity. And if it gives him 5 points, he's out. Even if the framework allows for 30 points, he's getting out at 5. Now, I already know some of you hotshots has been doing it for a while, or like to be critical or troll me, and you just run your mouth. Oh, this guy, he's telling his son it could move 30 points, but he's getting out at 5 points. Who does that? Someone that's never traded live money before. That's who's doing it. Okay. Someone that's already made 400% in 1 month. That's who's doing it. Okay. Someone that hasn't had a losing day in weeks. That's who's doing it. So sit down, take notes, or move along. In the afternoon, there's a setup as well. We'll get into that in a moment. But the next area of opportunity is the 9:30 hour. Okay, so equities open at 9:30, and this is one I outlined. The market was down here. I mentioned on Twitter, I said, okay, they opened it up at 9:30, initially started sending it lower. And we'll talk about that in a couple minutes of what that was and what information can be gleaned from that. But I said that they're going to take price up into the fair value gap and also clear 41.05. It's all time and date stamped, folks. You can go back on Twitter, take a look at it. It's there. It's undeniable. It's not ambiguous. It's very specific. Look at the time on your chart. It's here. I'm saying at 41.05, that's where the buy side liquidity is. That's where the stops are. And it's a fair value gap there. It's going to reprice there. And then you're going to see the move, the real move for the day. Market drops from there. I went short on a demo account. And as price went below this low, I tweeted first. Go back and look at the little recording, okay? But this setup here eventually came back and ran back above the short-term high and ran here. So we went one more time where? Above the New York midnight open price.